Hello everyone and welcome to this week's webinar. My name's Craig Erlam, Senior Market Analyst at OANDA. Thank you very much as ever for joining us. I really appreciate the time that you take to do so. Hopefully you'll get plenty from this to make it worthwhile, and I will try and keep it to the half an hour, although I have failed to do so in the past. But if anyone does need to drop off towards the end, if you are running something else, please do know that it is available also on YouTube a couple of hours after this recording. It'll also be available on the OANDA MarketPulse channel. That's marketpulse.com, which is the website you can see hopefully in front of you now with the economic calendar on it. And then it's also, you can also find it on my Twitter page, which is Craig_Forex. So I'll be tweeting that out later on. So yeah, I'll try and keep it to the half an hour, but if I have to go over in order to get all the charts in, then you will be able to access it elsewhere. So yeah, I mean, it's been another incredible week, really. It's almost hard to know where to start. In keeping with the last webinar, I'm going to keep to the economic calendar to begin with, and then from the political stories point of view, I will utilize, I will go through that as and when we come across it in the charts, see how that works. And again, if you've got any feedback, please don't hesitate to give it. If you want to see the rest of our analysis, which comes from myself and the rest of the team, do check out marketpulse.com, and it's on the home screen here, and then you can utilize the economic calendar as well here. In terms of the week on the economic side, it was quite a slow start to the week, if I'm perfectly honest, primarily because the US midterms does act as something of a distraction. But we did have a bit of economic data on the start. We had some the services and non-manufacturing PMIs and the composite as well from the US, all very strong figures coming in at a very timely release for US President Trump and the Republicans, given the fact that the economy is doing so well right now, which is obviously partly due to the efforts they've made over the last couple of years and something they want to build on in these midterms. We also have the Caixin Services PMI, and again, that's slipped quite a bit. So there's, again, increasing concern over the strength of the Chinese economy, the headwinds being faced by this trade war with the US, as well as more of a structural slowdown there as well. We are seeing efforts being made to try and support the economy, but at the same time, those efforts are being engineered in such a way that focuses more on the transitional aims of the leadership. So rather than just throwing cash at infrastructure spending, for example, we are seeing things like tax cuts being proposed, enablers for the consumer effectively, as the country does transition towards a more of a consumer-driven economy. But again, this takes time, and the initial shocks from this trade war and the slowdown, which is otherwise expected anyway. I mean, the economy's growing at 6.5%. That's not that's quite a phenomenal growth rate at the best of times, but that of course is slower than it was a decade over the course of the last decade. This is a bit of a concern, I think, for markets right now. One of the main underlying risks that we have really for markets right now. In terms of today, we have had some disappointing figures from parts of Europe. They're not shown up on here because I have filtered it down to the medium and high tier economic releases, but the Italian services PMI was particularly worrying. That actually slipped into contraction territory. Signs there that the economy is fundamentally experiencing a few difficulties. The interesting thing with these services PMIs and the manufacturing PMIs alike is that it factors in outlook as much as the current circumstances. And I think given the political situation we have there, the fact that Italy is taking on the European Commission over its budget, the uncertainty that that produces, the impact we're seeing on borrowing costs in the economy, and also the fact that we are generally seeing a slowdown in the Eurozone economy over the course of this year for a number of reasons, really. The fact that it was growing at a very strong rate by its own standards last year, and these things tend to average out. There's also capacity issues as well, which I think is what dragging the Italian economy in particular, like the German economy, is having its car industry hit by new emissions standards and new emissions tests right now. That's creating bottlenecks in the production phase. Things like this is really acting as a drag, and all is culminating at the same time when you've also got global economic uncertainty. You've got the slowdown in China, which is a big importer from the EU as well. Then then you obviously naturally do see these weaker figures. Now, this isn't being seen across. We did see slightly weaker in France. We can see here Germany, Spain, and the Eurozone as a whole. The numbers are slightly better than we were expecting, but again, compared to what we've seen previously, they do show something of a slowdown. We had the RBA interest rate decision overnight rate statement. The RBA have made it quite clear that their next move in interest rates is going to be higher as opposed to lower, but also that it's unlikely to be in the near to medium term. And the minutes we saw overnight, really, the statement we saw overnight, effectively just confirmed this. They did upgrade their growth and inflation forecast slightly for the next couple of years, but equally, and while unemployment as well actually has come down slightly faster than they expected, and they revised down their unemployment forecast, there is other challenges facing the economy right now. A slowdown in the housing market, for example, in some of the major cities, including Melbourne and Sydney. There are other credit issues, I think, in the economy right now. I think the RBA stuck very much to the message that they are going to be very gradual in any changes to monetary policy, and this has really got people not expecting a rate hike in Australia until late 2019, early 2020. So we're not looking at any near-term shifts here. I think the Australian dollar has benefited slightly from these improved growth forecasts, but in terms of what it actually means for interest rates, I think it's marginal at this stage. And I think the challenges facing the economy, including the slowdown in China, which is of course a big importer of raw materials from Australia, I think the culmination of these means that it's probably going to be very little movement now over the medium term. Obviously, you can see this one at the top. I can't for the life of me understand why it's only a medium impact event. The midterm elections is what's effectively caused this kind of slowdown in activity at the start of the week. The reason why, and if you check out my Twitter account, I did actually tweet out an article from Bloomberg earlier on, which was a really good summary of the midterm elections and what they mean and what the possible outcomes could mean, where we could see disruption, where we could not. The overall summary of that really at the moment is that as it stands based on the polls, and it's worth noting that the polls have been wrong so many times, just take the Brexit vote here, just take numerous elections that we've had here, what feels like an annual basis over the last few years, take the fact that the polls suggested that Hillary Clinton was going to win the election in 2016. So we have to take it somewhat with a pinch of salt, but the polls very much suggest that that the Democrats are going to retake the House, and the Republicans are going to retain control of the Senate. What that means is, to an extent, some form of political stalemate. It means that the chances of Trump getting through effectively abolishing Obamacare is unlikely. But also the flip side of that is that he's been very unilateral. His approach to trade wars has been unilateral, so he hasn't sought the support of Congress in order to impose tariffs, for example, against China. So that type of foreign policy is unlikely to change. The immigration side of things could be disrupted. His attempts to build a border wall are going to be increasingly difficult. I really recommend checking out this article for all of the smaller details on this, because it was a really good summary. But I think stalemate is the key takeaway here if we do see Democrats take the House. The interesting thing is how will the markets respond? And I think the markets will be okay with a stalemate, because a lot of Trump's pro-growth, pro-economy agenda and pro-market agenda has already been passed, and the bulk of that was the tax reform. That's the main reason why we've seen the stock markets making such extraordinary gains. That's why the economy is heated up that little bit more. He did propose more tax cuts a week or two ago. I do think that was very much with an eye on the election as opposed to anything that's been in the pipeline. That was a 10% tax cut for the middle class. That would be very unlikely, I think, to get through in the event of a split Congress. And I'm not even convinced it would get through, if I'm perfectly honest, even if Republicans controlled the House and the Senate. The alternative, though, is that if these polls are once again underestimating the Republicans, then I think markets would very much probably view a Republican-controlled House and Senate more favorably, because that enables the president's agenda. And we've seen in the past stalemates aren't necessarily great, and we've seen it before, for example, with the Obama administration, how difficult he found running the country at a time when he was facing opposition from within Congress. So the election should be quite interesting. It will be occurring overnight here, so this is something for people on this side of the pond to wake up to tomorrow morning. I don't think we're going to see a massive market reaction either way, and they may be famous last words, but given how much the markets are priced in right now, a number of websites do really have the results as being pretty clear. And if they are in line, there's a really good website, 538, I think it's called .com, not 538.com, I think it's called, and they have the possibility of the Democrats controlling the House at around 87%. So very, very confident about that. So, and if that's the case, then I think this is something that the markets will just have priced in. So we might see some volatility. We'll certainly see a shift in focus, and hopefully see more movements towards the back end of the week. But again, another very interesting one. We do have jobs data from New Zealand later on today. Heading into the latter part of the week, we've got the RBNZ interest rate and statement. Again, no change expected there for some time. Very similar in a way to the situation in Australia. Trade data from China, very interesting right now, given the trade situation with the US. Are we going to see another record US surplus? And if not, are we going to start to see the tide turning? Are the impact of tariffs going to start to be seen on the trade data? And it's not just the tariffs themselves. It's also the fact that we did see a front loading of orders prior to the tariffs coming into place. So you tend to get this averaging out effect. So for that surge in orders prior to the tariffs, do we start to see a drop off in below what will be average orders in the aftermath as well? We've got the Fed decision late on Thursday. Again, this is going to be really interesting, and even though we're not expecting any change to interest rates, it's not a live meeting as it were, we've seen a lot of market activity over the last month, and the trigger was quite clearly Jay Powell's comments. And that's not to say that I blame him for the market moves. I think these are two very different things. His comments about not being near the neutral rate and potentially going beyond was quite clearly the reason why the markets took a turn. But the reason why the market ultimately took a turn is because of the amount of underlying risk in the markets right now. The reason why, and that we can talk about trade in the US, we can be talking about midterm elections, but we can also be including Brexit, Italy, emerging markets, China slowdown, among other things. In that the situation with Saudi Arabia, which is going pretty quiet right now, oil, which was at the time looked like it was heading towards, people were talking about $100 a barrel, since come off. All of that underlying risk, it just seemed to culminate in this one comment which sent everything south. But that's something that the Fed will be paying very close attention to. And again, there's the difference between the Fed being to blame and the Fed being the trigger. I don't think the Fed's to blame, because all you have to do is look at the inflation data right now to see that we've seen a number of rate hikes. We're now at 2.25% or 2 to 2.5%. And inflation is still on target at 2%. So from its inflation at 2% and maximum employment goal, it's hard to argue that it's doing anything wrong. But that doesn't mean that their comments can't trigger sensitivities in the markets, and that's, I think, what's happened. So be interesting to see if they have a slight change of wording here about how fast they're going to be raising interest rates and when they are going to be raising interest rates as well. So that's something I will certainly be focused on Thursday afternoon. Friday, again, plenty of economic data, inflation data from China. We'll get the RBA monetary policy statement as well. And then GDP, manufacturing and industrial production data from the UK early in the morning. This is the new monthly GDP data. For some reason, someone decided that we needed this on a monthly basis now, just to make it that extra bit more granular. And again, it's debatable about just how useful that is. And then we'll start to get things like these Fed speeches start to appear again, because as you'll remember from last week's webinar, if you attended or caught the recording, the blackout period for Fed speakers begins just over a week before. So it begins at the start of the week prior to the Fed meeting. Now, this has been longer than normal because the Fed meeting's on Thursday rather than Wednesday. I'm not entirely sure whether this is due to the bank holiday that we had in the US last week, or because of the election that we've had on the current week. I imagine it's probably got more to do with the election, but I might be wrong there. And then we wrap up with the Baker Hughes oil rig count as well. So again, we're not shy of economic releases over the course of this week. Naturally, if you're asking me which is the most important events, then from my perspective, it is these US midterms. It's the Fed decision on Thursday. And I think in terms of what people will be most interested in, I think it's that Chinese trade balance data earlier on in the day as well. So moving on to the charts now. The euro move has it has been interesting. It's been a bit of a weird one. I think the Italian situation really has not confidence. The data we've seen hasn't really helped the situation much either. We have seen a little bit of general dollar strength. You'll see the dollar index is back towards its highs. I'm not sure if that really has the legs to be sustained, but I guess we will wait and see. If we look at the 4-hour chart, because the daily chart hasn't really changed, we're hanging below this 50 fib, and it's worth noting that that 50 fib is very long term. We're talking about the lows back in the start of 2017 through to the highs earlier on in 2018. We've been lingering around the 50 and 61.8 fib for quite some time, but this is acting as something of a resistance level now around the 114.50s. It was support previously as well. Without wanting to add more fibs on, you can see that during this decline, we did come up and we hit that 61.8 fib before turning south. And then if we just add the fib back to the most recent low, with that 61.8 fib level acting as the swing high, we've hit that 61.8 fib once again, and we've rotated lower. So this is really interesting for me, because this suggests that momentum is still with the downside. But we have rebounded higher off these 113.50s. So this is really interesting for me. If we break through those 114.50s, then that would suggest that this bottom is solid. And there's been something of a waiting game despite some near-term weakness. If we rotate lower and go through the 113.50s, then I think those 113s come under severe pressure, and there is potential for them to break. That still leaves some time for some downside. For those of you who have listened to this before, you'll know that from my perspective, I'm a medium to longer term dollar bear. I think still that much of what's bullish about the US dollar is priced in. And for that reason, I'm skeptical about how much lower we can go. But furthermore, if we look at some of the things which is causing difficulty for other currencies against the US dollar, look at the euro situation right now, take Italy. I think these issues are going to either be resolved in the case of the Italian budget, either through negotiations between the Rome and Brussels, and that could come as early as next week. Italy needs to submit its new redrafted budget by the 13th, so that's a week today, and we'll see how they follow up with that. Salvini, who's the leader of the League, has suggested that they're not going to change their fiscal stance and that they're going to stick to 2.4%. This is the level at which they clearly believe that the debt level will not increase or fall, more likely, but won't increase. And they think for 1 year they need to loosen the purse strings in order to try and generate more growth. We've had 2 decades basically of between 1 and 1.5% growth in Italy on average. They clearly believe that they can grow their way to a lower debt, and that other efforts have been tried, including austerity, and failed. The European Commission clearly doesn't agree with their forecast. hopefully some form of compromise can be found. The European Commission has to tread very carefully due to the rising populism we are already seeing in the euro area. But if this situation is resolved either through a compromise, or alternatively, if this does turn into a long consultation period and considerations for whether the Italy are going to be sanctioned, which can take months and months and months, this effectively starts to be forgotten about and can work to the euro's benefit as well. With these things in mind, that could be negative for the dollar. And when you add to that other currencies like the pound, where it really hitting a crunch period for the UK right now with Brexit talks, and if we start to see progress being made, we've already seen what benefits rumours can do. If we start to see progress being made here in the coming weeks, and I do expect that to happen, probably by, it wouldn't surprise me if it takes until year end, but it could be earlier, then I'd expect that to benefit the pound, which again would work against the dollar. Moving on to the pound, while we're on this subject, we have rebounded from these lows, again testing these previous lows here around the 127s, just shy of 127. We've rotated higher. Some positive rumours really was the trigger for this. We had last Friday morning or overnight on Thursday, we had Dominic a letter which was apparently sent by Dominic Raab. The timing of the letter, though, was debated to I think it was the Treasury, suggesting that they believe that a deal will be done by the 21st of November. Now, that strikes me as being very ambitious and makes me think that the letter was older than was initially claimed. But that really got pound traders excited. Pound traders are very, very susceptible to these big swings in the currency on the back of Brexit-related reports. Negative news, as we saw throughout this period here, really drags it lower, or no news at all really drags it lower. Positive news gets these massive surges, so that volatility very much still remains. It was also followed up as well by reports with it from the Times that the UK had come to an agreement with the EU on financial services post-Brexit. The UK firms utilising the equivalence regime to retain access to the European markets. This is huge. Just for some perspective, and for those of you who may have seen one or two of my interviews, I am reiterating points I've made in them. Financial services, and this was from a report for the City of London website, I believe, by PwC last year. Financial services for the UK generates 3.5% of employment. It generates 7.2% of GDP, and it generates 11% of tax receipts. This is a huge industry for the UK. It hasn't been talked about as part of the deal's potential future deal so far, simply because the deal is focused on customs, and this is a little bit more complex. But, and also the EU has stressed repeatedly that it's not discussing future deals, future trade until the exit is agreed. Naturally, you would expect that these conversations are still taking place on the sidelines at the very least, even if that is their official stance. And these reports would suggest so. What was interesting was both sides rejected that this deal had been agreed. Now, the pound didn't really reverse its losses despite this. And I think for me, that the reason for that is twofold. And again, we go into more detail on this in the podcast, which we release each week. That's OANDA Market Insights. It's released every Friday. Please do sign up on iTunes and wherever else you get your podcasts. I think the reason's twofold. One, the reason why, in terms of why it was rejected, one, I think, is just because they said they wouldn't discuss it. And two is, the reason, sorry, my bad, I've lost my train of thought. The reason why I think the pound continued to move higher despite these rejections is twofold. One is because this idea that there's no smoke without fire. This story came out of absolutely nowhere. And to combine with that is that it came from a very reputable source in the Times. So those two things, I think, is why the pound continued to trudge higher, despite the fact that the EU and the UK rejected it, and we continue to trudge higher since. And again, we've seen random rumours today, which again have generated moves in the pound, got people a little bit excited. We had a DUP official who said that it looks as though we're heading for no deal Brexit that week in the pound. We had more comments from Dominic Raab. I think he gave thumbs up on the way outside. That generated movement higher in the pound. I mean, these things are so silly, but it shows that people really want to be bullish the pound, especially at these levels. But we're not seeing any serious signs of progress. I believe Theresa May has a meeting today. We'll see how that goes with her cabinet and see what more information we can get. But people clearly want to be bullish on the pound, and these things are just taking longer than they think. In terms of where the pound can therefore go, in the absence of positive or negative news, and I mean substantial news, I expect more consolidation, the type of which we've been seeing for some time. You can see we continue to see slightly lower highs. We're not breaking below these 127s, which is encouraging. Don't be surprised if we can see more consolidation, but plenty of volatility as these reports come out. If we break through 132, then that would make me bullish into these kind of 133s. A breakthrough there would be significant for me, and I think that could start to look very bullish indeed. Euro sterling, like I say, these Brexit reports really did get the pound traders excited. We came back towards this kind of 50-61.8 fib zone. I think it's a coincidence that we rotated here. It's purely based on news, but it's always nice when we rotate into in a nice fib zone. But we did rotate in between those 50 and 61.8 fib. We broke through that rising trend line, which we highlighted in the previous webinar, and it's been all south since. And now we're trading back at the lows around these 87.25s. Looking at the momentum indicators, there's no reason that I can see not to remain a little bit bearish for now. The momentum is starting to slip off on the 4-hour chart. You can see on the MACD histogram, the stochastic and the moving averages as well. We are starting to lose a little bit of momentum, but we're not seeing any big cutbacks either. So there's potential for this to continue to slide into these kind of levels. I think 87, 86.50 continues to be this major support level, and I struggle to see us breaking these supports without either a Brexit deal or a very clear signal that a Brexit deal's close. And I'm not talking about an official coming out going, a Brexit deal's really close. It may be that if it's a significant figure, but we've had that so many times. So we are seeing momentum slow as we start to approach those lows, and that's very much been the case for some time. Aussie dollar, we've finally seen the break of that falling trend line, the falling channel. So I think this could start to look nicely bullish as far as I'm concerned. We broke through the channel following this really strong day here. That was on Thursday last week. We broke through the double bottom neckline, and that move was pretty quickly completed. We've got this move here from around the 70.50s through 71.50. Which gives us a possible price projection around 72.50. We came just slightly above that, and we touched that before correcting a couple of days ago. So the double bottom possible price projection has been achieved now. We've seen a little bit of consolidation and following that, and now it seems to be edging higher again. We're above the falling channel. We're testing this 55.89 simple moving average. We've gone through the 55. We're now testing 89. A breakthrough there, and these kind of 25s become the next potential level of resistance for me. But broadly speaking here, I think this is now starting to look nicely bullish, and another thing that could potentially contribute to the to some dollar weakness. In terms of the things I'd be looking for to suggest that this is taking a reverse and that this is a false breakout, I'd need to see a breakback through 71.50. That would take us back inside the falling channel, take us back below these previous this previous peak as well. Dollar CAD is a bit meh, if I'm perfectly honest. I don't really know how better to describe it. We have broken above the channel, but I'm still struggling to be particularly bullish on this. We're not really generating much upside momentum. Every time we break higher, we seem to correct lower. We did it here, we did it here. We did it more recently a few days back, and then we corrected lower. We are still making higher highs and higher lows, so that suggests there's reason for bullishness. But all you have to do is take a look at these momentum indicators to see that there's nothing really supporting it. We're in that 50-61.8 fib zone, which we're really struggling to break through. Again, you can look at the momentum indicators here. There just doesn't seem to be anything supporting new highs at this moment in time. I wouldn't be surprised if we fail to make a new high and fail to break through these 131.70s and actually rotate lower, if I'm perfectly honest. For that, then it's a case of looking for potential confirmations of these breaks. So I'd be keeping a close eye on this kind of trend line here. Sometimes harder to draw the trend line than others. I'd be drawing it somewhere around here, and I think a breakthrough there. So you're looking really for a breakthrough kind of 130.80, and that could potentially signal a rotation to the downside, especially if we fail to make a new high in the process. Like I say, I just struggle to get particularly bullish about this, despite the fact that we had a breakthrough that falling channel. And again, if we do see this is another potential weaker dollar sign as well. So something to be keeping an eye on. Sterling CAD very volatile like the rest of them. We did approach the previous low. We fell short of 166 before that news came out, and since then we've just been soaring higher and higher, back through the falling trend line, through the most recent falling consolidation trend line, and now we're heading back towards these 71, 75, 72, 73 kind of range. If we can break through that kind of 73s, through the previous high, through the previous low as well, then this would be a nice little bullish signal for the sterling CAD pair. But again, we need to see more positive Brexit momentum here in order for that to happen. And as always, all it takes is some negative comments, and that rotates quickly to the downside. The pound really is one of those at the moment where fundamentals are driving my view, and my fundamental view is bullish for the pound. Technicals I'm paying a little bit less attention to, just purely because technicals are not driving it day to day. It's not driving it intraday all the time. Sometimes technicals are playing more of a part, but the problem with that is that the market is very susceptible to a constant news flow, constant rumors, constant reports, constant speculation, and that does have very outsized impacts on the movement in the currency for such a big issue. So the technicals can give some indication as to how the news flow is progressing, and it quite clearly now you can see that it's progressing positively. It gives you indications on where the market doesn't want to go, and in this case it doesn't look like it wants to go below 166. We've tested it 3 times. We almost tested it a 4th time. A break below 166 would potentially signal a much more negative twist with regards to Brexit. But more importantly, we are just seeing general choppiness here. So don't be surprised if we hit these 172 areas and then just start to chop again inside this zone. It's all going to be a case of how long we're waiting for actual progress. Kiwi dollar, much like the Aussie dollar, we've seen a nice little bullish move. We finally broke through the falling channel. We failed to make a new low here before rotating higher. We saw general support in this region around 165, 65.50, providing further signals of a potential bullish move. And we finally saw a very bullish breakout through that falling channel. We've run into a bit of resistance around these kind of 67s. That's not really a surprise. This is a prior zone of support and resistance that we've highlighted previously. If we can break through here, then things start to look a lot more bullish again. As always with these, you're looking for bullish signals, then you're looking for bullish confirmation. Initial signal was a failure to make a new low, and after that, it's all about confirmation. So confirmation was the breakthrough the trend. Confirmation was breakthrough the moving average band, which had been support and resistance previously. Confirmation would then come from the breakthrough prior support and resistance, and so on and so forth. In terms of where we can go, I'll be keeping an eye on the fib from the high to the low, but I think into these kind of 69s is perfectly reasonable given the size of the move we've seen. And as you'll see, this, like many other things, is consistent with my dollar view also. So it's always nice when these things do line up. So certainly one to bear in mind here. So yeah, there you go, like around these kind of 69.30s, that's what a 50 fib combines with a 200 233 day simple moving average. That'll be a very interesting test for me, but there is different hurdles to pass along the way. And like I say, this kind of 67, then 68, 68.50, and then 69.30. They're the 69, 69.30. They're the levels I'm keeping in mind for this. But nice little bullish setup here, I think, for Kiwi dollar. Dollar yen's a bit more erratic. We are seeing the yen safe haven play come into force at times. It's going to be interesting to see what happens here when we do see, or if we do see, the dollar pair gains or the dollar in correction mode, as we're seeing against other currencies, at the same time that we see risk appetite return to the markets. There's not much really bullish appetite for yen generally from a pure currency perspective, given the central bank does seem keen on maintaining very loose monetary policy. As you can see, the dollar has been gradually climbing higher again. We've remained above the cloud and the 55.89 moving average. We've tested the cloud on a number of occasions, and while we've had a couple of little tiny false breakouts, we've broadly speaking stayed above. I guess the key test for me for the dollar yen here comes around these 114.50s kind of level here, because a failure to go through those highs, a rotation potentially prior to that and a move lower could be seen as a bearish move for the dollar. And if we look at the most recent moves that we've got here, we're not exactly seeing a huge amount of upward momentum, which would be a worry for me. So one potential level, for example, to keep an eye on could be the levels which we're trading at now. That said, this is one of those rare occasions where when we're seeing choppiness, I'd have a little bit of interest in the 78.6 as well, because even if we do see a very steep correction on here, if we do rotate off that 78.6 into the cloud, then that would start to act as a potentially worrying level for me, or a worrying signal. Sterling yen has much of the same issues as all the sterling pairs, being the volatility. Potential more of upside here if we do see this coincide with return of risk appetite. We are seeing a test here around the kind of 148.25s. Again, you've got the 200, 233 day simple moving averages coming into play here. Not been overly consistent in the past, so I'm not focused too much on that. But you do have these kind of falling highs here. Again, this is a very loosely drawn channel, so I'm kind of just monitoring this as opposed to looking at this as a strict area of resistance. I'm more focused on 150, to be honest. 150, if we break through there, then things start to look quite bullish. I'm not sure we've got the legs to do that yet, but that's the type of upside move that I'd start to really pay attention at. Everything else, I'm just looking for little tiny signals along the way. Nothing is more volatile and sketchy and choppy than euro yen, though, because we have seen a breakback below here. We have seen choppy markets for some time. We even got confirmation with the lagging line breaking through before that broke back above as well. I'm not really too bothered with euro yen right now, to be honest, because of that choppiness. Lots of long upper and lower wicks, which again is just a highlight of this choppiness. Yes, we could rotate lower from the cloud, would drag the lagging line back below. Would that make me feel particularly bearish? No. I think I'd need to see a break through these lows around 125 before I start to feel in any way bearish. If we see a rotation off of this kind of 130 level, which would roughly represent the 50 fib of the recent high to the recent low, potentially that's a bearish signal. If we drag back through the bottom of the cloud, bringing the lagging line with us, then again. But I'd want to see some previous lows being taken out. Nothing like that would provide me with too much comfort right now, if I'm perfectly honest. I just think this is an extremely choppy chart, and I'd be just as unsurprised to see us break through 130 and up towards these highs of 132 than I would if we rotated off the 130 and came back towards 127. So I don't really hold much of a bullish or bearish bias on this right now. The one bullish case for it would be if we do see a move higher in the euro against the dollar, if we see some positive progress with regards to Italy, that could be, and a return of risk appetite all at the same time, then that would give me a fundamental bias towards these kind of 133s. But from a technical standpoint, I just don't think the signals are there just yet. Okay, that's all. As always, I have run over, so apologies if I've kept you a little bit late. Hopefully you found that useful though, and again, you can watch this back on YouTube, Twitter, and marketpulse.com as well. Please do sign up as well for the podcast. That's OANDA Market Insights. The next one, it will be released on Friday afternoon. You can also sign up to Alfonso's podcast as well. That's OANDA Market Beat. Also available on iTunes or wherever else you get your podcasts. And aside from that, I wish you all the very best of luck with your trading, all the very best of luck with your learning, and I'll hopefully catch you again this time next week. But until then, have a fantastic week, and I hope you have a great weekend. Thank you.